Hello, everyone. My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. Well, this week, and most likely into next week, I'm going to be doing something different, okay? Rather than looking at individual stocks or going through different styles of technical analysis, what I want to do is I want to focus a little bit on the Elliott Wave Principle, but not do what we've done in the past as far as learning the rules and guidelines, how we use it to forecast markets, Fibonacci retracements, Fibonacci objectives, all of that. And I want to go ahead and begin to take things to the next level in our education. And primarily, it's how to actually trade the wave principle. Okay, now Ralph Nelson Elliott discovered the wave principle, I believe, back in the 1930s. And it is, again, a very powerful form of market forecasting, especially when you apply the technique correctly. There's a lot of practitioners out there, unfortunately, that do not practice the technique correctly, and you can tell. But bottom line, if you follow the wave principle and you really want to integrate it into your, say, trading style, forecasting style, market analysis style, then I strongly encourage you to, again, adhere to the rules and guidelines of the Elliott Wave Principle. And there's no other better book than the Elliott Wave Principle, written by A.J. Frost and Robert Prechter. That's still the go-to. Okay, so if you want to learn about that wave principle, this is the book. There's no other better book out there, in my opinion. I've been doing this for over 30 years now, that explains the nuances and the application of the Elliott Wave Principle. But there is a drawback to the book. And that is, it does not take the step in evolution in explaining how to take the wave principle from a market forecasting tool to a trading tool, a trading technique. And this is where my book comes into play. My book, the title is The Visual Guide to Elliott Wave Trading, written by Wayne Gorman and myself. So what we do with my book, The Visual Guide to Elliott Wave Trading, is we take the next step, because whenever Ralph Nelson Elliott developed the wave principle, again back in the 1930s, he did so as a forecasting tool, not as a trading tool. So at some point, if we're going to be utilizing a tool, we want to take the next step in its evolution. It's like, okay, hey, that's great. I love MACD. MACD's great, but how do I trade it? Or candlesticks. Candlestick analysis is powerful. You know how big of a fan I am of Japanese candlestick analysis, but how do we trade it? How do we put it into action? And again, that's what my book. So the two books together are great companion books. The Elliott Wave Principle, written by A.J. Frost and Robert Prechter, gives you the solid foundation you need to be a competent Elliott Wave practitioner. And then my book, The Visual Guide to Elliott Wave Trading, takes you to the next level on how to apply it from not only a market forecasting perspective, but implement it from a trading perspective. So that's what we're going to be doing today, tomorrow, and probably into next week, because I'm going to go and walk you through each individual pattern and how to trade it. Now, before we start, remember, I'm offering this information, this education, as a guideline. Okay, if you like my techniques, great. If you don't like my techniques, great. And also, too, you can always modify the techniques to meet or match your own risk tolerance, or however you look at the market, whether you're a short-term trader, day trader, scalper, or perhaps even a long-term investor. So let's go ahead and get started. Now, in front of you is a cover slide that you've seen quite frequently if you've been a subscriber to Market Academy for any length of time. And it shows you the 5 core foundational patterns of the wave principle. The wave principle starts here. It is built upon these 5 patterns. Now, as you know, there are some variations to these structures and formations. For example, the expanded flat is a variation of the flat correction, and the running flat is a variation of the expanded flat. Okay, but again, it all starts here. Everything that we know about the wave principle builds from this foundation. So what we're going to be discussing today is how to trade the impulse wave. Tomorrow we're going to look at the diagonal. With Thursday we'll look at the zigzag, and then next week we'll go into the flat and the triangle. So let's go ahead and get started. Okay, now before we look at specifically how to trade an impulse wave, what I want to do here is I want to discuss the 8-wave cycle to provide context for what you're about to learn. Okay, now an 8-wave cycle is nothing more than a 5-wave move up followed by a 3-wave decline. 1, 2, 3, 4, 5, 6, 7, 8. 8-wave cycle. Okay, and then upon the completion of wave C, you see the prices advance again, either in wave 3 or wave C. Okay, so within this 8-wave cycle, what are the trading opportunities? Now, some of you might think that, okay, hey, let's buy the origin point of wave 1, we ride wave 1 up, we sell wave 1, take profits on wave 1, and then we're short in an attempt to capture, any kind of thing we can get to the downside in wave 2, and then we position ourselves for wave 3. And then once wave 3 is complete, we're short in anticipation of wave 4, and then we buy wave 4 in anticipation of wave 5, and so on. Okay, that's what I call riding the waves, and I don't think that's very realistic, and I have issue with that for several reasons. Remember, I've been doing this for 30 years, and I've been an active trader for more than 20. Wave 1, I don't focus on trying to trade or attempt to trade wave 1 because that's my setup wave. For example, let's say you do pick the bottom of a market and you enter in, say at some point you're going to recognize it. Maybe that's the 50% point. Well, you'll experience a little bit of joy as you see further rally in wave 1, but the next significant move is going to be wave 2, and that's going to take you right back to where you got in at. So that's why I really don't focus on wave 1. That's my setup wave, okay? That's beginning to build the foundation. Now, as far as wave 2, okay, I don't trade wave 2. I think unless wave 2, and let me put some context to that wave 2, that idea of trading counter trend moves. If this is an intraday or daily price chart where wave 2 could last 3 to 5 days or maybe even 3 to 5 weeks, I really don't mess around with trying to trade the intricacies of a corrective structure. If it's a wave 2, it's a wave 4, it's a wave B. I kind of don't waste my time. And the reason why is because there's so many different patterns, so many different pattern variations that can actually occur in a wave 2 or in a corrective structure, be it 2, be it 4, or be it wave B. So what I recommend is focus on your trending price moves. So simply put, within an 8-wave cycle, you have 4 primary opportunities to trade. Number 1, you position yourself to the buy side in anticipation of wave 3. Number 4, you pick up, you get the bottom here in wave 4 in anticipation of wave 5. You have 5 waves up, you pick the top in anticipation of the 3-wave decline. And then once you have your down up sequence for wave B, then this is viable. Each one of these trades is positioned in the direction of the larger trend. Okay, so within an 8-wave cycle, there are 4 primary trading opportunities. Now, what do you think is my favorite? Okay, well, my favorite, believe it or not, it's not wave 2, and it's certainly not this one here. I'm not a fan of picking tops or bottoms, and I don't particularly like this one as well. My favorite trade setup is the 4th wave pullback. Because if you have a 1, 2, 3, and wave 3 is just clearly defined, you have the acceleration gap in wave 3 of 3, wave 3's traveled a 2 or 2.618 multiple, then it's just really a game of patience. You wait for the pullback in wave 4 and you buy it. So this position here, it may not be the, say, position that gives you the greatest return, but in my opinion, it does give you the highest probability of success because remember, truncated waves, that occurrence whenever a wave that should make a new price extreme is unable to do so, is a very rare event. So even though I'm going to be looking, say, to make less on this 5th wave move than I would on wave 3, the probability of success of this being a profitable position is much, much higher. Because early on back here, you still don't know if this is a wave 1 or in 2, or this is A, B, and C. Nothing's more frustrating than being in a wave C advance, thinking that it's actually wave 3, only to be proven incorrect. So let's dive a little bit deeper into specifically how to trade an impulse wave if this is your trading style. Okay, so again, this is your 5-wave move, waves 1, 2, 3, 4, 5. So some people think, and again, I'm not a big fan of this idea, is that as soon as you can count 5 waves up and done, 1, 2, 3, 4, 5, then take the position. I'm not a fan of that because it's missing a critical element. It's missing a critical ingredient, and that is what I call confirming price action. So to drive home the concept of what confirming price action means to me is, let's say, for example, I'm at an intersection and there's traffic in front of me. It's going left and it's going right, and I'm at the traffic light, or I'm at a stop sign, and I want to make a left-hand turn. Okay, but I look to my left and I see a car coming, towards me, and it has its blinker on. It has its right-hand blinker signal on, suggesting that it's going to turn at my intersection. Okay, it's just going to pull up to where I'm at and basically take a right. Okay, how many of us simply see the blinker and pull out in front of the car? Well, if you live in Florida, and I live in Florida, you don't do that because it's actually quite common to see a driver down here have their left signal on or right signal, turn signal on for 20 or 30 miles. I know there have been times when I haven't been paying attention and I've had my turn signal on for an extended period of time. So what you do as a driver is the blinker, the turn signal, basically just says, okay, hey, pay attention. But then you demand confirming price action. You look for the car to slow down. You look for the car to commit to the turn by turning the wheels. And then once you see that commitment by the car, then you feel safe and confident in actually making your left-hand turn. That's what I consider to be confirming price action. So going back to this diagram here, just because you can count 5 waves up and done, in my opinion, doesn't mean anything, because the market continue to go higher and higher, and then we may have to come back and adjust the wave count where this is 1, 2, 1, 2, and now you're looking at wave 3 of 3, and you're playing the short side in an exceptionally volatile bull market. Okay, so we need to pick our spots, and my spots or my trading style is always to wait for the confirming price action. So what does confirming price action look like? Okay, well, here's an example, and again, this is a suggestion. This is not a rule. This is a guideline, and you can take these guidelines and actually use them as a starting point in developing your own methodology that best fits your say, risk profile. Okay, so if I'm working an impulse wave, waves 1, 2, 3, 4, and 5, then before I give myself, I call it green lighting, before I give myself a green light to even begin thinking about taking a position to the sell side, I want to see prices come down below the extreme of wave 4 of 5. Okay, so let me put those labels in there just so we're all clear on what I mean by that. So let me move this over here. As you know, each impulse wave develops in a smaller 5-wave impulsive structure. This is why we look at the substructure of an impulse wave or refer to it as a notation as a 5-3-5 pattern. So within wave 5, you're going to have 5 smaller waves. So what I want to see initially, before I even give myself permission to even begin thinking about taking a position to the sell side here, because again, I'm somewhat adverse to picking tops and bottoms, is I want to see the market fall back below the wave 4 extreme. Okay, if we can fall back below that level and do so in 5 waves, then at that point, at least I have evidence. I have price evidence to suggest that we have a top in place. Now, combine this with, say, another indicator or oscillator, such as, let's say you have bearish divergence between the occurrence of the extreme of wave 3 and the extreme of wave 5. Then that's even more evidence. Or if going back to a week or so ago, we were looking at candlestick patterns. Maybe if we look at a daily candlestick price chart or a candlestick price chart relevant to whatever we're looking at here, maybe you have an evening star formation or a bearish engulfing pattern. But going back to this idea here, the whole concept, everything that I talk about in my book, The Visual Guide to Elliott Wave Trading, and those guidelines that I offer, they're just that. They're guidelines, okay? So what I want to see here before I even begin thinking about taking a sell side position is I want to see the market turn down impulsively, and fall well below the extreme of wave 4. And then at that point, I've got permission to begin, putting together a trade plan as far as taking advantage of any kind of downside potential. So that would be my entry, the extreme of wave 4, of course, not on an intraday basis, but on a closing basis. And where am I wrong? Protective stop. You always, always, always have to identify where your analysis is no longer applicable. And this simply speaks to one of the key principles of becoming a consistently successful trader, and that is risk management. I know in sales, if you're in the sales business, whether it's selling cars or planes or boats or clothes, whatever, one of the mottos is always be selling, always be selling, always be selling. From a trader's perspective, the motto we have is always manage risk, always manage risk, always manage risk, because things can go south very, very quickly, and we all know that. So you have to understand, even before you put the trade on, where you're wrong. At what point does the analysis fall apart? Does it go south when it's no longer applicable? So I always like to identify that critical level. Okay, so if we fall below this point, I'm done. I'm out. Price action has deviated too far from my original assessment or my original forecast, so I need to exit, get on the sidelines, reconfigure what I'm thinking, and then maybe go back in with more high confidence situation. But how do you trade an impulse wave? Again, because it is one of the 4 types of viable setups. Remember, going back to this slide here, within an 8-wave cycle, you have 4 opportunities, 4 primary setups. Buying the wave 2 pullback, buying the wave 4 pullback, and then, of course, picking the wave 5 top, because whenever you have 5 waves up and done, what happens? According to the guideline of depth of corrective waves, you see a retracement. Typically back to the prior 4th wave extreme, but if this is 1 up or A up, you're still going to come down to maybe a 50 or 618% retracement, so there's still going to be opportunity to the downside. So here are the 4 primary trades. So what we're looking at initially is how to trade an impulsive structure. And that begins initially with 5 waves down, under the wave 4 extreme. And then also too, here's a way you can modify this guideline and maybe begin to develop your own guidelines is, say, for example, what you may want to look for would be a 5-wave decline below that 4th wave extreme. And then from there, look for a small 3-wave counter trend move up. And what this does is it delays your entry. But in so doing, it actually gives you more confidence because now you have 5 waves down followed by a 3-wave move up. And then you can even begin to say, by waiting, give you more confidence and allow you to actually even maybe possibly mitigate risk even more so. Or you can look at it as a stair step where, say, you take your initial position on a break of the extreme of wave 4. Okay, and then once you have 5 down and look for wave 2 up, then what you can do is possibly add a second position, your protective stop still being up here. And then once wave 4, once price action begins to fall below this extreme here, then what you can now do is lower your protective stop to just above the extreme of the most last recent 3-wave advance. So again, as the market moves in your direction, you're moving your critical levels, you're moving your protective stops. And again, I offer this as simply a guideline, a suggestion. It's a starting point. And if you don't have my book, The Visual Guide to Elliott Wave Trading, you can easily pick that up on Amazon. Well, tomorrow we're going to be discussing how to trade the diagonal. And there are several different techniques on how to enter a trade based on a diagonal triangle setup, and we're going to be going through all 3. Well, that's about it for me for today. Thank you very much, and I'll see you tomorrow.